Everybody, welcome, welcome, welcome. My name is Rich Hanlin. With me today is the Ricardo Sheard, and we are going to talk about something that a lot of loan officers don't do, especially here at Xpert Home Lending. But he just finished one. I think we've had a couple more, Ricardo, maybe a handful, no more than five. And it's the one-time close construction loan at UWM. I've been wanting to talk to you. I've been following along with you, the highs, the lows, the ups, the downs, the do's, the
Certainly.
don'ts. But I wanted to, now that it's closed, because they do take a little bit of time to get figured out. But I wanted you to take us all the way through from, hey, you got a call from a borrower, and
Yeah.
he said, "Can you help me do this?" And you said, "Ooh, okay, I can help you do that." And you went and learned that program. You knew we had it at UWM. Take us from the beginning, how it all started and how it developed, the good and the bad, the pitfalls, and all the way through the transaction.
All right. Well, thank you for having me on, Mr. Hanlon. It is an honor to be here.
Call me Rich, please. I know I'm
Okay.
great. I'm great now, but
Out of respect. Well, okay, Rich. It's uncomfortable for me to do it, but I'll call you Rich. Yeah. So how this came about. So it was an investor. Before my mortgage career, I was a real estate investor on a small level, did a couple deals, but nothing really came up too much of it. So a little bit about my background. I'm a father. I'm a young father of three, a 5-year-old girl, a 3-year-old boy, and now a 2-month-old girl.
yep, that's right.
Yeah. So at the time, we were back in 2023, and the market completely went crazy. After COVID and stuff, everything was going up in price. What they teach you as an investor is like buy low, sell high. But in this particular market, it was almost virtually impossible. So I was like, okay, I just
Right.
had my son. I just had my son February of that year. So I'm like, okay. So now I got these two kids. I still have my full-time job. What is it that I could do right now, with having two kids and I don't have to travel and show houses? So I didn't want to be a realtor. And then, so my mom actually joined before me. My mother, shout out to Deborah Sherrard. I love you. So, and she's actually doing a VA one-time construction loan. So we'll have to put
Wow.
her on another
Keeping
time.
it in the family.
Yep. Yep. Certainly. So I decided to become a mortgage broker, and it fit me like a glove.
Right.
So I gave you a backstory. I went too long, but this particular transaction was from an investor that I spoke in the past in one of our groups, and he called me and says, "Hey, listen, I have a home that I purchased back in March of 2023. I've been looking to knock it down and build it up and move into there." So I was like, okay. And then I asked around. Thank God, Rich, for the community that we have and expert network for Facebook. That certainly helped a lot. So I just asked, gave a scenario, and they told me do the UWM one-time construction close. And at the time, it was partnered with Granite. And
Granted. Yeah.
those of you that don't know, Granite is the one responsible for vetting the contractor and vetting the project. So that was a process in and of itself. So it got me in the right direction, and and shout out to Vinny Sito and UWM kind of helped me walk through the process of how to go about things. So it was a two-part process, but yeah, it's like the mortgage part, the process is still the same as far as the underwriting and filling out application and like debt to income ratio, making sure everything matches up in the income that it all works. But it's a more drawn out process as far as vetting the contractor and vetting the project and making sure that the person that you're hiring to do the work has the experience. So it was a process.
Now they don't have Granite anymore, right? They change, but you had started yours when they were using Granite, but I think they took that in-house, if I remember.
Yes, they did. Yes, they did.
You are UWM Live, they talked about taking that in-house so they could control that faster,
Yes.
and but you went through the old process. So are you still part of that investor group?
Yeah. Yes. They haven't had any events, but I still communicate with a lot of people from there. Still communicate with a lot of
Okay.
people.
And so this guy calls you up, says, "Hey, I bought that property, but now I'm ready to knock it down." So he went and got he already had the drawings,
Yeah, he
mocked
already
up, or
yeah, like, this is what made it easier for me. The process was easier for me because usually when you're going from the jump, like, from scratch, trying to get the property, get the
right?
permits, that could be long. But this particular investor had everything ready, so it made it easier for me. It made it easier for me. So he had the drawings, he had the permit, which is very important because sometimes it could take months, could take up to a
Yes.
year to get it.
By the way, tell everybody where your area of business is in the United States.
New Jersey.
And so this guy built in New Jersey.
Yes.
What did he knock down? How old was the building?
How old is the building? The year it was built? 1971?
Yeah,
Yeah.
a lot of old stuff there.
Yeah, yep, and a lot of homes on that street, it was pretty interesting. A lot of homes on this is in Edison, New Jersey. So a lot of homes on this particular street, like old ones were old ranches, and then they knocked it down to build a two-story. That's where you really make your
Right.
money.
So tell me this. Did that guy walk into some equity by building and doing what he did?
Yes, because he
I mean,
bought the house.
what did it cost to build and what did it appraise for? Or do they appraise it for exactly what it takes for it to be built?
Okay, so he bought the house back in March of 2023 for $315,000. He bought
Okay.
it, and he was making his regular mortgage payments along with the mortgage of the home that he's currently staying in. So he still owed 244,000. So we had about close to $70,000 in equity. But the way they do the appraisal is a little bit different. Yes, I mean, you still do the comps with similar properties. They like to do it within the 1 mile radius. It'd be better than less than a mile so that you have a true number. So they do it based on because he was building a 5 bedroom, 5 bath house.
Wow. Okay.
Yep. So we couldn't really find that many comps. We found comps for a 4 bedroom, 4 bath, 4 bedroom, three, but there wasn't any. And it was a bigger square footage. I think it was going to be 3,100. So they do it they did it mostly by square footage, but it's a lot harder to judge based on a comp on a new home that you're
Okay.
looking to build. Yeah.
Well, and they give them land value. People always, and I don't know if you're going to be able to answer this, but did he have a mortgage on the property when he knocked it down?
Yes.
Did he share with you at all what the requirements are when you have a mortgage on a property that's already built and you totally level it? You only have so much time to build because that lender lent on a property that was already developed and they're happy that you're redoing it. But at the same point, once you knock it down, it's just land. And they're like, hey, we had a mortgage on a property, a stick built property, and it's now land. I don't even know if he said, a lot of people don't even say anything because they just keep making the payment, right? And who knows, after the fact, he might have refinanced it because I don't know if he had investor financing or what he had on it, especially if he moved into it. Because yours would have been, did you do owner occupied or did he build it for, you say he's going to move in?
Yeah, he's gonna move in.
Okay, so he was definitely getting owner occupied rate. And tell me how the rates work because, people don't understand. You're not getting a straight up Fannie Mae, Freddie Mac, VA. There's typically a little bit of a difference when a construction's involved with it because they have this carry for, I don't know how long yours was, but is it up to 18 months or is it
12
12
months.
months?
Well, this is
12
the
months at
one-time
UWM.
construction loan, 12 months.
How long did it take him to do his?
Well, we're in the beginning stages of it, but, I'll give you a two-part answer to your question before. So, you were asking about, him knocking it down and having a mortgage on it. How do we combat that? We instead of doing this as a purchase, we did it as a refinance so
Right.
that we combined both how much was owed on the property plus how much it was gonna take
Okay. They
plus the
paid off
budget.
that original loan.
Yes. So it was interesting because his original budget was and the amount and this is including the 5% contingency. His original budget was $699,000. So that plus the how much he owes, which is 244,000, came out to be $943,000, which was considered a jumbo loan because I think in Middlesex County, and I think the maximum loan amount I think is like 800. I don't remember the exact, but it's $806,500. So it was considered a jumbo loan, and because
Right.
it was considered a jumbo loan, his rate was a little bit higher. It was at like 8.25%, and then so we were going back and forth about that, and not only that. that put us over our DTI limit. It put us over our DTI, even though, their combined income per month was 20,000. So I said, hey, listen, like there's a couple things we can do. Either A, we could put, another co-borrower on to get you more income, or we have to restructure the project, get the budget, like take some things off, like lower the budget. So then after giving some time to think about it, we decided to lower the budget, and we lowered the total budget, both of the construction and the mortgage. We lowered the budget to 800,000, which thus gave him a better rate because it was no longer considered a jumbo loan because
Right.
we were under the maximum loan limit, and it took his interest rate from 8.25% to 6.875%, which is pretty darn good for a construction loan.
Yeah.
And his interest rate before then, when he got this house, was at 7%.
Okay. Yeah, when I built my house, it wasn't appraising for what I was trying to do. And I was off by about $200,000. And the first time I just took it to a new place, but I wanted a whole new appraisal, and they wouldn't do it at the bank I was at here in Georgia. But again, it came in low. So hey, that's cool. But I'll do my due diligence, and it might have came in 50,000, but I was still 150 off for what I needed, or I would have to come out of pocket more. But I was like, damn, I already held money back to do some things like a pool and stuff like that after the fact. Because you don't get much value on the purchase of the property when you're building if you try and have the pool in on the front end. Uh, so you're just going in the hole quick. But I had to cut it back, and basically, and people say, well, how do you cut back? You can't just, well, you could build a smaller house. In my case, the finish amenities. In other words, I'm going to go ahead and put these cheaper fireplaces in now. I'm going to put in a cheaper insulation versus the highest end insulation. And I just did some little things in my finishes to qualify, but I still put those good things in. I just came up with the cash on top of it, but I wanted the maximum loan because I still wanted the project to go. Now, I could have just went with the original project and appraisal, but it worked out better. It saved me about $100,000 out of my pocket to mess with the construction of the loan. But is it a lot of moving parts? Yeah. Because remember, it's not just you and the lender. There's also this construction part of it with typically a general contractor who oversees everything. They're only going to get paid. How many draws? Is it 4 or 3 with UWM? Or do you know?
It's on a project by project basis.
Okay.
With
Mine was
whereas
4 draws.
well, ours was 9.
9 draws?
Yep, 9.
Wow. Okay. I haven't seen that one. My contractor would have liked 9 draws because he would have got paid faster, because what happens is they'll put the money out. Well, they get the first draw, but there's stages of the house and they have to come out and look at it before they let you get to the next stage and the next stage. So there's also the permitting part. The county has to come out and look at it. So there's sign offs. It's not for everybody. And if I'm being honest with my own experience, I have not once in the 2 times that I have built from scratch, bought the land and built a house, I have not walked into any equity. Matter of fact, by the time I'm done, and here's why. You got to do everything. I mean, you got to put the pipes in the ground, the sprinklers, the landscaping. Nothing's done. It's just a bare lot. And if it's a home I'm not going to live in, I would do it differently, much cheaper, more of a renter's grade. But it was a home I was going to live in, so I went higher in. I brought my California dollars out from Georgia, and it took me those dollars go far in Georgia from California. I don't know if they would go far in New Jersey, but I think I know of at least 2. Now, this guy did it to live in it. We had another person that built a owner-occupied 4-plex, and it was beautiful. And this guy had no experience whatsoever, but he was going to live in one of the 4 units, and he had a 2-car garage, and all the attached units had 1-car garages, but it was very modern and brand new. And he built it for like 500. Check this out. When it closed, it was worth like 650. So he walked into about 150,000 of equity, and on top of it, he got an owner-occupied rate. Now, what's the rule? You got to live there 12 months.
Yes.
You live there 12 months, and guess what? You've met the requirement. So we have people that are doing that, where they buy and they live for 1 year and they just house hack it for 1 year. and then they just move on. A lot of my VA people do that. Tell me a little bit. Your mom's now doing it. Is that because she saw you do it? Because now you're in a local expert in New Jersey?
Well, thank you for that. So, actually, my mom is not, actually not doing it in New Jersey. She's doing it in, Florida, and,
Wow. Okay. You have to get her
Florida.
on to talk about her experience too.
Yep, and I'll give you a overview. So, the realtor that she's working with is a former veteran,
Okay.
and, him and her clicked instantly. So, she's done a couple deals with them, did a couple down payment assistant loans with, and then now she's, doing a VA loan. She's doing a VA one-time construction, and this particular person is a veteran and
Okay.
owns the land. So, like I said before, that certainly helps, but he flat out owns the land, and, yeah, and so she's been working on this since July of last year because of mostly permitting. Permitting has taken a very long time, and trying to find the contractors that, that have the experience to do this type of work, and they're very with granite. I mean, I don't know how UWM is going to be in the process. I've never worked with them, but
Right.
granite is very strict about, like, okay, this particular process. Okay, what is your 3-year experience with this? And what was the outcome? How many have you done? And not just with that, credit score. A lot of investors get the notion that, okay, your credit score doesn't matter. Certainly it does. Certainly it does, because a construction loan is a more risky loan, in my opinion, is a more risky loan because a lot of things can go wrong. But what helped my particular buyer, I'm sorry to go back and forth and everything,
No, you're
but
fine.
what helped my particular buyer, even though he only did 3 ground up constructions in the past 3 years, his credit score was excellent, and that took us over the hump.
Well, were you talking about your borrower's credit score?
Yes.
Okay. You
Yeah,
get a lot of people
the
that try and
person
be what's called a owner builder. And I don't know if they allow an owner builder because that's the whole vetting process behind the scenes is can this person get this project done? There are some people that will take and they'll hire out all the people, and it does save some money. I don't know if they do that. Maybe they do, but like if I want to be my own general contractor, I'm sure they're going to vet me to make sure I have the wherewithal to and experience. So if I had zero experience, I'm assuming they would make me get a general contractor. And
yeah,
that's what Granite was doing for you. They were vetting that guy or person to make sure that that company had no issues in the background because there's a lot of mechanics liens when it comes to people getting upset that work didn't get done right and they didn't get paid right and they slap these mechanics liens onto a property. And that's part of the vetting at the end on the title side is making sure there's absolutely no recorded mechanics liens that's going to go in front of that UWM. So it's always an interesting process. But I remember you called and asked me about this, and I'm like, shoot, I haven't done one. I haven't done one with UWM, but I'm looking to do my own. But I'm going to do the investment one because you can do it as an investor too. You just got to put a little more down. But I want to build a fourplex after I saw that one borrower do it and I saw his return. I'm thinking, wow. I mean, most fourplexes are old and people still get top dollars. But if you put a fourplex out there and halfway through it, you could put it on the market and you could probably have a buyer, an investor buyer for that property before it even closes, or you can finish it, get it fully rented, and then put it up for sale, or you could keep it and put it in your own portfolio. But we're watching these people and watching you watching your mom. And if people say, "Oh, that's too complicated," it's like, no, you just got to dive in and use your resources. UWM jumped in to help you. How much help is UWM in a one-time close?
big help, big help. Shout out to Vinny Sito that helped me walk through this. Vinny Sito, Devin O'Ray, they were
Right.
excellent in the process. And shout out to all of our teammates on Expert that had previous experience in that. I don't want to single them out because I'm afraid I might miss people, and but a lot of people helped me in this process, and but they were very helpful. UWM particularly on the mortgage side because there's a lot more things that when you go past vetting the contractor, vetting the budget, vetting the architect plans and all that sort of stuff, going through the mortgage underwriting process is similar to like doing a regular purchase, but it's a little bit different because you're basing it on a house that hasn't been built yet, and it's interesting. And particularly for the state of New Jersey, it gets very interesting, particularly when it comes to taxes.
Right. I was going to ask you to talk about that because you kind of ran into that.
Yeah. We have an interesting way. I'm trying to break it down as simple as possible. So a lot of when you calculate future taxes, typically with different states, they go by the millage rate, which is like a certain percentage, and that's it. And you times it by the appraised value, and then that seems simple. New Jersey, we always got to do things different. We always
Right.
got to do things different. So usually you leave it to your title company to kind of help you out with that. I was asking other expert members, hey, like, does anybody have any way that you can calculate taxes in the state of New Jersey? And nobody did. It was like they said talk to your tax assessor. So I called the tax assessor myself from the Edison tax assessor, and they told me how to do it. So basically, not only you take the appraised value, you take the current tax rate for that year times the town rate. Like for this particular one, the tax rate was like 5.91, and then the town ratio, they call it, it's the tax rate and the town ratio. It's so dumb. But yeah, the tax rate, which was 5.91, and then times the town ratio, which was 29.69. So you times those two numbers times the appraisal value, and that's your new tax rate. So at the time when he got the property, he was paying per year about $7,100 in taxes. When we did the future value, when I did those calculations, it went from 7,100 to darn near close to 18,000, and that rate. And we were at like 47 point, I think 5. That took our DTI over to 51.4%. That was
All
yeah.
right. You never told me how you solved that debt ratio problem.
Okay, so we were looking to, well, first we were looking to buy down
And
the rate.
well, wait a minute. Let's back up real fast.
Oh, sorry.
When did you find that out? This guy had already started this trend, or were you still trying to get him approved?
We were in underwriting. We were in underwriting.
Okay. All right.
We were still in underwriting. We were at the end. We only had 2 more conditions, and that was one of them.
All right.
And so we were like, okay, we're gonna buy down the rate. We just have to bring more at closing. He didn't want that. He wasn't happy about that. I'm like, okay, well, we're gonna have to cut our budget. I mean, so we had to go through the whole process, and I give Granite a lot of credit when we started doing the one-time construction loan. When other people did it, with Granite and UWM, people were complaining about how slow the process was with Granite. By the time they got to me, they perfected their process. So they were they're very responsive. Every time there was a problem, they would get back to you within 48 hours. So shout out to them. So what we had to do, I had to call Granite and restructure the whole budget. So because of that, we had to get our whole total budget from 800,000 to 788,000. So we had to cut our budget by 12,000 to make the loan work, which got it at a 49.9%. But it only took a matter of 2 days. So shout out to Granite for doing that for us.
Okay. That's actually not too bad. You're just over and you're able to pull off a 40. So we can go to a 49.99 on an owner occupied construction loan. That they're not going to let you do that on an investment property. I just point that out to people. Have this guy built before or was it his first time?
He's built before.
Okay. All right. Did he talk to you at all about how it went versus other companies he's used or anything?
He said it took longer because a lot of times he's built, but as an investor. He's built
Right.
as an investor, got hard money. Usually hard money
Yeah. Yeah. Okay.
Hard money is very quick, but they charge you like 12%, 13%. With this, it was a lot longer because you're dealing with a mortgage with a construction loan. So the vetting process is more.
Yeah, they used to have a takeout loan at the end that would pay off the construction loan, but you're automatically approved for it. But you had two different loans. Now you kind of know your loan, right? And isn't it interest only during the build period?
Yes, and correct me. I made a mistake in the beginning. It's not the construction loan is not for the period of 12 months. It's for 11 months. It's for 11 months, and it's interest only for the
Why
first.
11?
I don't know. That's UWM's rule. I don't know why they
Okay.
did, but it's but yes, it is interest only. Interest only for the during the time of the construction, and then after it's done, you actually have the option to float your rate down, depending on if the interest rate gets lower. I mean, that remains to be seen, this
Right.
day and age.
Right. How is it compared? Because you did what? Conventional. Your mom's doing VA. How's that? Or did you guys talk about the differences between the two programs?
The difference is, you're dealing with VA. That's a little bit more things that she has to do because things like, certificate of eligibility, entitlement, all that sort of stuff, so that's a little bit more involved. So, yeah, it's more involved because of the VA portion of it, and there's
Makes sense.
more from what I heard when like, with any government loan, not just with VA, but FHA, like, as far as, like, the inspection, they're a little bit more stricter with that.
Yeah. Would you do it again?
Absolutely, I would.
Okay. Are you fearful of it now, or you're like, nope, I could do this?
I'm not fearful of it.
Are you looking to, you know, what happens sometimes, Ricardo, is people think, oh, I'm afraid to do this, this, and this. I've never done that, and then they do it. I used to do 203K loans, and the first couple were nightmares. And I'm like, no wonder nobody does this. But then I was like, one of my mentors said, if you could get good at those, you can pretty much have loans around the clock. And I'm like, okay, I'm going to get good at this in California. And I did for a while. But what I didn't like is I had a lot going on, but only a few would close. A lot fell out. And so, if you had for every 10 loans, only two went through, but you were working on 10. And most of them fell through because the buyer's agent. They didn't buy the property at a good enough, low enough value for current condition. And then they come in and try and over renovate, and the final appraisal just can't cover it. But once these people get their ideas that, hey, this is my primary kitchen, I want it be it off the hook, and you're like, yeah, but in that neighborhood, that kind of a kitchen, you're 100,000 over budget. Well, I want that, or I don't want to do it. And it's, the appraisals are more. What was the cost of the appraisal on a one time close?
The one I just did, $1,000,000.
No, but what was the cost to get the appraisal done? Is it the same price as normal, or
It was $625.
how many times did you automatically have the appraiser having to go out there and sign off at the end, I'm assuming, to show that it's completed? Did the appraiser go out for the stages of the pictures, like at each stage? Well, I guess you're going through that right now. So,
Yeah, I'm in the beginning stages of it.
okay, they had to do that on mine. So I had to keep there were some follow-up appraisal fees that were built into my loan above the original appraisal because they knew he's going to have to go out there multiple times, including the 1040D at the end or whatever. It's good. Now, obviously, your mom's working on hers. So was she working on hers before you started, or did she take it on afterwards?
She was working on hers before I started.
Okay. So has she done those before? All right. So it runs into family. People don't realize your mom lives in New Jersey too, right? Yep. So it's family affair. Your mom's been a loan officer for a long time.
Yep. Well, first she started off as a realtor, and then she became a loan officer in 2022. Really
Okay.
rough doing this, and was helping taking care of my kids at the same time. So it was amazing to watch,
Right. Is she still doing real estate? Are you doing real estate too?
like being a realtor and stuff.
Yeah.
Oh, I've never been a realtor. I'm not going to.
Okay. Well, people don't know because he's now in his three-piece suit, but he's got his picture on a lot of bus stops around New Jersey, and he goes around recording himself going, hey, I know that guy. It's kind of funny to watch, but I'm proud of you, man. That's not an easy loan. And it's not, how long did it take from start to finish for the loan part to be done where you're like, cool, and you get paid? Is it 30 days? Is it a 60-day, 90-day?
Now you're talking about the loan part, like the underwriting
The
part.
loan part, the underwriting, granite. This guy comes to you and says, I want to build, but he already had the land or the house that he was going to rip down, and he already had uh, his drawings. He already had the permits, and he said, I want to get approved. How long did it take from that point for granite to review and for him to sign docs and for you to get paid on it?
Well, for me, it took longer because, again, this was my first time doing it, and I had to lean on a lot of help. I had to lean on a
Right?
lot.
Pardon me.
Really started this. We were going back and forth. Actually, he first reached out to me during Halloween, and we were going back. Really didn't think he was serious, so I kind of really didn't. But then we really started getting serious right before Christmas. Right before
Okay.
Christmas, I think December 23rd, and then we went through everything. He actually got The contractor approval we got on January 6th, then we did the project review, then the loan, everything. So from December 23rd, and then we closed on April 24th. So 4 months. So it took longer, not because it's a long process, but it was mostly because of me, because I never did this before, but I leaned on, and thank God he was very patient with me during the process because I had to lean on a lot of help. I had to lean on a
Okay.
lot of help.
We run into it sometimes where on the other end, they're hitting that 11 months and they go out and they're like, hey, this property's not done yet. So we had one in California that someone was building and they're like, oh, we need more money to finish. And it's like, well, wait a minute. You guys went outside they sure did. They made some changes as they were going into it. They ran into unforeseen things. They're getting to that 11th month. Instead of being done, they're like, hey, we're still 3 months out and we're going to have to come up with a little bit more money. So I always wondered how UWM would handle that, and they actually refinanced it with a new one-time close because they already had all the paperwork and the contractor's already approved. They just changed the loan, and I can't remember if they reappraised it based on it, but they refinanced the one-time close with a new one-time close, and then that guy's in that second one right now. But rates got worse, but he was stuck, right? Because he has to finish the house because we can't do a normal loan on it. We can't do an equity loan on it because it's not completed yet. So I have ran into it on that side where they don't finish it. And you'll see a lot of people that will start projects with their own money and they'll run over big time because they don't have the experience. They don't put the contingency in case people wonder what the contingency is, they know that people run over. And so you put a little extra money aside, and then eventually, if you don't use it, they can pay down the mortgage at the end when everything settles up. But many people end up using that contingency, if not also going over it. And it's the hardest thing for people to do when they're building. You tell them everything that you're doing. These are the fireplaces that are going in. These are the type of doors going in. Hey, these are the appliances going in. This is what my kitchen's going to look like. And then they appraise it based on all that stuff. And then guess what? A sell over at Home Depot. And they're like, oh, I'm going to change out. I'm going to go with these lights. I'm going to go with that tile. I'm going to change out my appliances. I'm going to go with these new fireplaces. Oh, they have new technology. I want that. Oh, I didn't even think I want to have a Cat5 wiring in my walls because I want to run internet to all the rooms. And they just start making changes, not because they're bad people, but because it's just sometimes you don't think of that stuff, or you think, I'm going to use this because it's on sale. I had to do that way. And we got all of our lights are half the cost. We're going half the cost on the doors, and doors can get expensive, but it messes with the original budget of what was expected in that house and what was appraised for the value. And so there's things that you can't make a lot of changes unless you're willing to come out of pocket at the end, because you don't just refinance. Not everybody is at the right place where they can refinance. That one guy just happened to be, and it helped that he owned the land.
Big time.
That adds a lot of equity into that. When you don't own the land and you're buying the land and the property at the same time, or the construction loan, you don't have a lot of room to be off because you have no equity other than what you put down. And a lot of people put minimum down on a construction loan at one time when they're doing it that way. So they're not for everybody. I know I've gone through two of them. The first one was easier than the second one, and California versus Georgia, I could see where there's a little different in the way they do things. From a construction standpoint, we get a little more weather here where they have more sunny days to work. It took me 14 months. I went over in my case, I could have swore I had like 16 months on the front, but I was getting towards the end. And finally, I just told them I'm moving in because it was literally, they won't sign off. And sometimes it's for the smallest things, maybe the baseboards aren't on, right? And you're like, well, the house is livable. The electricity's on, the water's working. I'm moving in. So I know people that have moved in, like they have a lower, a kitchen like in the basement, and they move into that area, even though the top's still being worked on. I see a lot of different things. Or if they have 2 units on the property, like a barndominium, and they've got a loft area, they have a kitchen, stuff up there, they'll move into it while the house is being done. I mean, there's so many different directions, but when you told me New Jersey, I'm thinking I've never seen anybody. Obviously, people can build anywhere, but this guy probably walked into some value because San Francisco, everything's old. They knock down the house and they rebuild what they want because there is no vacant land. So it sounds like New Jersey is very similar to that.
Yeah, very similar. Very, very similar. In California, there's, like, stricter laws out there because of the environment and stuff, like, that's on a whole 'nother level, you know?
I hear you. I like that. I see you got bling on top. You got expert bling on the shirt. You're sporting it all. Man, I appreciate you doing this. I think a lot of people are they're mystified by how that works. And I gotta tell you, I mean, Ricardo, I don't mean this mean, but you're newer to the industry. And you got into it because your mom, but she's been doing it now, but she was in real estate, but you have no background in real estate. You're trying to do the investments. But to jump into this type of a loan, a lot of people, number one, they get nervous about it. It looks and sounds overwhelming, but it's like you just gotta do your first one. And then your second one will go so much smoother. And your third one will go even because you'll be like, okay, I know exactly how they're going to ask or run this. What's my situation? Oh, you have no extra money and our debt ratio is already maxed out. And I got to know my taxes going into it. I bet you'll never get hung up on the taxes again in New Jersey if someone builds. And because that's a big difference.
Yeah, that was a little scary. I was like, "Ah, I'm gonna lose
For
this."
most people, that would have been a deal. Because I mean, what was it? 7,000 to 18,000. So it's what, almost 900 more a month?
Yeah. Yeah, just about yeah.